Welcome to Market Tape, your favorite Monday show. I'm Nathan KC Nwokoro. The essence of this show is to help you make sense of happenings in capital markets around the world and to pinpoint how you can use information from this show to better outcomes for your portfolio and take your investing game to a whole new level. If you have not subscribed yet, I encourage you to subscribe to this show. You don't want to miss any of the episodes. And while we're at it, don't forget to hit the notification button so you never get to miss any of the episodes as soon as it drops. There's only one word I can use to describe what is going on with capital markets around the world, and that is mayhem. Last week, it was a massive sell-off in the US, in Europe, in Japan, and even in Nigeria. The major indexes in these countries or in these markets saw a massive decline. In the last episode, we spoke about how sell-offs in the banking sector in Nigeria and industrial goods was driving the all-share index lower. And in the US, we saw how sell-off in the Magnificent Seven, that is the big tech companies, drove the S&P 500 lower. And of course, the tech-heavy NASDAQ went lower 2 weeks ago. Last week, it only got worse. And we're going to get into what is going on in this market. On the interest rate side of things, yields in the Nigerian market inched up a little bit, but it wasn't the same in the US. We saw interest rates on the 10-year bond decline from about 4.2% to 3.75%. It's the largest decline in a long, long time. What is driving these events in this market? We'll get into them on this show. But before we get into it, I want to talk a bit about the ongoing End Bad Governance protests in Nigeria. I listened to the president's speech yesterday, and there's only one reaction I got from that speech. I was disappointed. I mean, for about a month, we've had this clamor between protesters and government. The protesters on one hand said, we're going to protest from the 1st of August to 10th of August. Protest against bad governance. And the government's response was, no, you can't protest because it's politically motivated, because it will be hijacked by thugs and criminals. You can't protest because the government needs more time. But in any case, the protest started on the 1st of August. And what were the issues? People are dissatisfied. People are hungry. If you see all the placards people were carrying, the message was hunger, high cost of living, exchange rates, high energy costs. And the president just had one job: to explain in concrete terms what the government was doing to end the suffering. And make no mistake, when the president came in on the 29th of May 2023, he made some hard decisions. He announced the end of the fuel subsidy regime. He liberalized exchange rates. So exchange rate basically was left to the forces of demand and supply. He removed electricity tariff. And for many experts, financial experts, many analysts hailed that decision. But we have to understand that while majority of the elite, so to speak, and the economists and analysts were at home with this decision, the vast majority of Nigerians were not happy with this decision, because as far as they are concerned, that is the only means of getting benefits of governance. But what did we tell them? We said, give it time. It may be painful in the short term, but in the long run, it's going to pay off positively for everyone in the country. But while they were waiting, what did we see? We saw a ruling class that was insensitive, that was not sacrificing as much as they asked every other person to do. We saw an executive arm that was not cutting down its own cost of governance. We saw a legislative arm that was at liberty and blatantly approving all sorts of allowances for themselves. And this is what got the masses angry. So, what is the president supposed to do? Address these issues head on. I mean, he was speaking about the fact that revenue has grown by 9.1 trillion, or the fact that we made a revenue of 9.1 trillion in the first half of the year. I mean, the guys protesting do not know what to do with that information. They have no idea what to do with the information. The expectation, the reason why the policy pronouncements were hailed was because, one, people expected that the savings or the efficiency that we get from the removal of these subsidies would translate to better health care, would translate to access to quality education, would translate to an end to insecurity, would translate to improved local production, whether it's in terms of crude oil and refining capacity for the country. This was the expectation. But after over a year and a half, there is no indication that we are headed in any of this direction. And that is why people are protesting. So the president was supposed to come out and address these issues head on. What people wanted to hear is how you're addressing insecurity, how you planning to end food crisis, because the inflation we are seeing today is driven in a lot of ways by the inability of people to go to their farms. And this is particularly problematic in the north. If you see most of the violence recorded during these protests, you had in Katsina, Jigawa, Borno, Kano, and Kaduna. And these are regions ravaged by insecurity and people unable to go to their farms. So what we expected the president to do was to address these issues. So basically, to me, this address is not for the protesters, it's for commentators and analysts, for economists to digest. Because I really don't know what the ordinary guys protesting on the street, the guys who are hungry, guys who don't know where the next meal is going to come from, guys who have no access to quality education, guys who have no access to health care. I really don't know what they are supposed to make of this address. For me, those are the issues that were lacking in that presidential address yesterday. And then again, it's quite worrisome that governance in our country has come down to handouts and giving palliatives. This can work for a while, but I can guarantee you it won't work forever. And the guys in power, if they are seeing this, need to start putting concrete steps in place to ensure that we give a better life to the ordinary citizens in this country. It's so important. We definitely will not continue like this. This protest was announced. I'm worried about the protests that will not be announced, the ones that will be spontaneous. And these are it's situations like this that we need to avoid as a people. Okay, to the business of the day. The NGX, the Nigeria All Share Index, declined by 0.43% last week, and mostly led by the banking sector and the consumer goods. The banking sector lost 2.17%, consumer goods lost 2.88%, and then industrials 0.03% decline last week. And to me, what I will attribute to this is weak investors' confidence. Of course, with the protests going on, many investors will have this wait and see approach to see the outcome of it before committing more funds into this market. And then you're also seeing the issue with FX uncertainty. Last week, we heard of the central bank governor reverting back to the Dutch auction system, all in a bid to bring back more confidence in the foreign exchange market. Currently, exchange rate is over 1,600, I think, in both the parallel and secondary market. So particularly for foreign investors, they want to see more stability in the foreign exchange market to provide some sort of guarantee that at the point they want to take out their money, they will do so without making losses from exchange rate conversion. And of course, we remember the bill before the National Assembly currently, or the bill rather that has been passed by the National Assembly awaiting the president's assent for a 70% windfall tax on foreign exchange gains by the banks. This will continue to put pressure on the banking sector until it's resolved. So basically, we understand why the Nigerian market lost 0.43% last week. This week is not looking to be any different. I expect a bearish sentiment to continue in the market this week. And of course, when we have this bearish sentiment, it's always an opportunity for investors to find undervalued assets for investment. Last week, we saw some outstanding results from some companies that we track. Presco published their second quarter report last week. Same with MTN and Seplat Petroleum. These are the three companies that we track that published their results last week. Most of the reports were quite impressive. Let me look at Presco. Presco had a revenue growth of 83% revenue growth. Their bottom line, profit after tax, went up by 157%. And this just showed the sheer dominance of Presco in that industry, oil palm processing. Presco and Okomu Oil are the two giants in that sector. And this result just goes to show how much monopoly, I would say, they have in that sector. The share of Presco is up 118% year to date. Seplat Petroleum also published their report last week, the second quarter report. Revenue was up 92%, and in profit after tax up 134%. Year to date, Seplat Petroleum is up 61%. One result that was not too impressive was from MTN. MTN had overall revenue growth of 32%, but the disappointment majorly to me comes from 14% growth in data revenue. Most of their revenue growth came from, 14% growth in voice revenue. Most of the returns or the growth in revenue came from data revenue, grew by 54.7%. Because of competition in that segment, I don't think this is sustainable. We want to see better performance from their voice revenue, SMS, and other services, which grew at 15%. Year to date, MTN is down 66%. It's an entry, provides a good entry point for investors. At this level, their price to earning ratio is quite low. Again, the bottom line of MTN is pressured significantly because of growth in operating expenses, growth in foreign exchange loss. The foreign exchange loss went up by 95%, and then the operating expenses is up by 40.5%. Not very good numbers from MTN. Obviously, it's not the kind of performance you expect from a giant like MTN, and one can only hope at this point that the foreign exchange market stabilizes. So the thing with MTN is that they have net foreign currency liabilities. And when these liabilities are converted at new exchange rates, it translates to a loss on their bottom line. And as long as we continue to see naira devaluation, as long as the naira devaluation persists, and as long as MTN continues to hold a net foreign currency liability position, then one can only expect that this kind of result would continue in future. But what I expect from the management of MTN at this point is to find a way to rebalance their books in terms of these foreign currency liabilities in their position. Now, over to the interest rate market. Last week, interest rates inched up a little in the treasury bill market, the bond market, and the Eurobond market. The Eurobond market, particularly due to the ongoing protest, it can only lead to worries for foreign investors who want to see how the issue is handled before coming back into the market. For the treasury bill market, we saw it was relatively quiet and very bearish because we saw a lot of sale on the part of foreign portfolio investors also. And all this comes down to the exchange rate instability that we're seeing. So in the bond market, the 2026 bond closed last week at 19.7%, 2034 21.7%. One of the most actively traded is a 2033, which closed at 22.45%. And then for the treasury bill market, we had the long end, which is the 1 year treasury bill, closing at 20.45%. So why these rates look very, very mouth-watering and enticing for fixed income investors, something else is going on that we all need to be aware of. That this interest rate party, may come to an end sooner than we expect. Last week at the FOMC meeting of the U.S. Federal Reserve, the chairman had interest rate at 5.5%. That was before some economic numbers, some economic data came into the market on Thursday and on Friday, and one of which was the unemployment rate, which went up to 4.3% as opposed to 4.1%, which was the market expectation. So the market saw a higher unemployment rate. Before then, we also had the new jobs created for the US, which came to 114,000 new jobs created as opposed to 179 expected in June. The market was not very excited about these numbers. And what happened next was the 10-year rate going down from about 4.17% going into the week and closing at 3.75%. You can make of this what you wish. But what I see here is the fact that the market is already pricing in the probability of a rate cut, a high probability at that, of a rate cut in September when the Fed meets again. But that decision and that the new data that came in on Friday did not hurt just the fixed income market. It also triggered a massive sell-off in the equities market, because this is what investors are looking at. In hindsight now, a lot of analysts are feeling like the Fed should have cut rates in July. And that is the funny thing about market expectations. The market can be thinking one thing at this moment, and then the next minute, new information comes up and we start to look at things differently. So basically, at the time the Fed took that decision to hold rates steady at 5.5%, it was within the range of expectations of the market. But now, we saw unemployment rate at 4.3%, and the market is feeling like, no, we should have cut, the Fed should have cut interest rates on Wednesday when they took that decision. Okay, so why these rates might look very attractive and mouth-watering, investors need to be careful because um, it's not going to stay with us forever. Because if you look at what is going on far away in the US, um, you see that it's likely that this party, this high interest rate party, may come to an end sooner than we expect it or sooner than we love. Last week, we saw weak economic data out of the US, which is heightening the fear of a recession. Last week, too, at the end of the FOMC meeting, the Federal Reserve Chairman, Jerome Powell, held interest rates steady at 5.5%. But just a few days later, we saw unemployment report come out at 4.3%. And in hindsight, a lot of people believe that the Fed chair should have cut interest rates in July. I mean, while we can all debate about this, the important thing here is that the market sentiment has suddenly changed from that of some level of optimism to a high level of pessimism just within a few days. When you put this information together, on one hand, the Federal Reserve holding interest rates steady, and on the other hand, weaker economic data in the form of higher unemployment rate, fewer jobs added for the month of June, and then weaker manufacturing data. What it shows is that the economy finally is showing some weakness. I mean, we expected this to happen at some point. But you know what they say about the market. The market will always overreact. And I think that is what is going on at this point in time. The market is overreacting because, for one, if you look at the GDP, it's still at 2.8%. The US has over 150 million jobs created currently. So putting all of this together, to me, I don't think it's a situation to panic too much about. Of course, no one expected these numbers to remain strong all through this. Of course, the whole idea about a soft landing was that we will not see any weakness until the Fed starts to cut interest rate. But at this point, it looks like the Fed is behind schedule in cutting rate, and it's almost all but guaranteed that come September, we're going to see at least a 50 basis point cut in interest rate. And when you start to see this cut in interest rate, the expectation is that it will percolate to emerging market economies like Nigeria, and you start to see a gradual descent in rates. Already, we've seen UK cut rate by 0.25% last week. If I were the CBN governor, this would be good news for me. Yeah, because it's an indication that the central bank may be under less pressure to keep raising interest rate. Because if you see the OMO auction last week, the OMO auction last week, demand was very weak, and it was a no sale at that auction last week. So it's something to keep close eye on as this evolves. But beyond that, the weak economic data also hurt significantly the stock markets, particularly the tech stocks. Last week we had quarterly reports from Amazon, Microsoft, Apple, and Meta. And what I took away from those reports is artificial intelligence. Right from the first time we heard about ChatGPT, the price of these stocks have been skyrocketing, to say the least, with the exception of Apple. All of these stocks, whether it's Nvidia, Meta, Microsoft, Google, Amazon, they've seen significant surge in their share prices. And why did this happen? Because we've been hearing artificial intelligence. These companies have been sinking billions of dollars investing in artificial intelligence, and the market believed them. We believe that with the sort of money they were spending on artificial intelligence, sooner than later we're going to start to see those investments impact on their revenue. Now, how long will the market have to wait before we start to see an impact on the top line of these companies? No one knew until you saw this job report. I think the market is at the point where it's suffering from some sort of AI fatigue because the market is saying you spent all of these monies investing in artificial intelligence. Show us how it's impacting your revenue. So if you look at all the earnings report that came out last week, on a different day, you call them impressive. Microsoft for one beat most of the expectations, except for cloud revenue. Amazon beat expectation except for ad revenue. Same with the tech stocks that reported last week. But one thing that most investors were looking for and did not find in this report is artificial intelligence. How is artificial intelligence leading to an increase in your revenue? And this is where Facebook Meta distinguished itself. Because despite spending the most, I think Facebook has one of the highest capex on AI. Despite having one of the highest investment in AI, they are one of the first to start to show some returns from AI. And immediately after the report, the Meta stock added almost 22% last week. On the part of Apple, for years, Apple has struggled to string together consistent performance in form of revenue growth because it appeared that they had run out of ideas in their iPhone series. But with the coming of artificial intelligence and launching their Apple Intelligence a few months back, expectation is high that the new iPhone 16 is going to come with advanced AI features, and the market can't simply wait for that. For the first time in a long while, Apple recorded a 5% increase in revenue, and that was exciting for the market. So the judgment day for Apple is iPhone 16. We're only hoping that it lives up to expectation. Yeah, because the market is waiting for that iPhone that is going to help you do a lot, that is going to process a lot of data on your phone and make life easier for you. And I just hope for their sake that they're able to live up to that expectation because what it comes down to is about meeting expectation or missing expectation. If you meet expectation, you get rewarded. If you meet expectations, you get rewarded, and if you miss expectations, you get punished. Overall, my takeaway from this event is for investors to be a bit more circumspect in decision making. I mean, you have to ask yourself, as we're seeing these sell-offs, what should you do? Do you panic and join the selling party? Or do you stay put? Or do you buy the dip? This is where investing gets difficult. This is where real investors are separated from juvenile investors. It's at times like this when the street is red, where everybody is running, people are scared. In terms of geopolitics, we are hearing of threats from Iran to attack Israel in retaliation for the killing of one of the Hamas commanders. And it's on the street you're hearing people talk about World War III. So as an investor, how do you digest all of this information? Are you going to panic and sell? So to me, you have to ask yourself, who are you? Are you an investor or a trader? So if you're an investor, you are driven by long-term expectations. But if you're a trader, you are driven by short-term sentiments. There's a quote from Warren Buffett, and I'm going to read it. He says, calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stand a romantic. So traders are like people who engage in one-night stands. They are always there's nothing invested, there's no emotion invested. It's about the screens. What does my trading rule say? If it says sell, I sell and I'm off. If it says buy, I buy and I'm in. But as an investor, you have more long-term approach to decision making. You want to look at these events, you want to digest them, you want to see how it factors into your long-term outlook. I mean, for a long time, we've been talking about how the market was overvalued. Market was trading at very high price to earnings ratio. Stocks like Nvidia were trading in their 60s. Most of the tech stocks were trading well over 50 in terms of their price to earnings ratio. Now we have an opportunity to buy some of these names at much cheaper valuations. So as an investor, you should be looking at names that you like with lower valuations, cheaper valuations. Definitely, I'm looking at my portfolio and asking myself, what do I need to buy more of to bring down my average price? That is how investors think. And of course, if you're a trader, you're going to think differently. But if you're an investor, you want to see this as an opportunity, but not as an opportunity to buy anything. I mean, it's an opportunity to buy, but make sure you're buying names that fit into your long-term investment objective. It's about having a style. It's about having a system, a strategy, an approach. If you stick to the strategy, you'll be fine. But if you jump off the strategy because of what you are hearing today, because some analysts are saying there's a massive sell-off, people are selling, and you want to join the crowd, first of all, ask yourself, who are you? Are you an investor or a trader? And then, of course, so for interest rate, I already alluded to the fact that the party may be coming to an end pretty soon. It's almost guaranteed that the Federal Reserve will start to cut rates from September. And when that happens, we expect that to also permeate around the world. Emerging markets, Nigeria, Europe, we've seen cut by the UK Central Bank by 0.25%. So their benchmark rate is down to 5%. And this is a theme that we expect to drive the market going forward. And lastly, if you're in this market long enough, you know that things can quickly change. Just a few months ago, we're speaking to the strength of the US economy. We're talking about how the AI rally had another 3 years runway to go. Yeah, but suddenly the story has changed. We're talking about a recession today. You can make of that. You can make of that what you wish. But again, the market is pricing in fear of a recession, no matter how much it is. The market is pricing it in today. So things can quickly change in this market. But the most important thing is stick to your strategy. We'll face geopolitical risk. We'll face market volatility. You face uncertainties. But if you stick to your strategy, you'll be very fine at the end of the day. Thanks for listening. Thanks for sticking with us on this show. Make sure you subscribe before you call it a day. Thank you. See you next time.